go ahead here. We're 2 minutes after. We still have a lot of people signing in, but we'll get going. Thank you again to everyone for joining us on our Get Crowdfunded webinar. Our goal is to complete this presentation in about 30 or 40 minutes. So we're not really going to focus on timing a lot. We're going to try to get it done in about 40 minutes and then open it up for Q&A. And then we're going to let the Q&A run without any predefined end time. So if you're interested in the Q&A, please stay with us. If you're not, feel free to drop off. As I mentioned, we're recording this as well. Let's go through some general housekeeping information. Attendees are in listen-only mode. For those of you who have dialed up on a phone, depending on how many people we have, we might open it up for audio questions and dialogue at the end. We'll have to watch and see how many people we've got on here. We've got quite a few people so far. On the right-hand side of your screen is a Q&A box. Feel free to type questions into that box throughout the presentation. We'd like to hold our questions to the end, and then we'll open it up for all of the panelists. But you can type your questions in at any time, and we'll be monitoring that throughout the session. Again, we are, recording. I'm getting over a cold, so I apologize. My voice is a little bit off register here. But we are recording today's webcast. Your participation in the event represents your acknowledgement of the recording and your agreement to participate. Finally, this is a live event where nothing ever goes wrong. And with that, let's introduce ourselves here. So first we have Maurice Lopez. Maurice is founder and CEO, as some of you heard, of Early Shares. They're based down in Miami. Early Shares is one of the platform companies that will be helping small businesses come to market with crowdfunding. He is a former CEO, and he is the founder of also Hot Brick Network Solutions. And he has held, as you can see here, various management positions in the telecommunications and technology industry. We also have Ruth Hedges. Ruth is founder and CEO of Funding Roadmap and also Crowdfunding Roadmap. She has 30 years in executive management in various capacities, including as CEO, being responsible for overseeing and directing all of the facets of the company's development and operations. And Ruth has more recognition than all the other panelists combined. She's been previously featured in the Chronicle of Philanthropy, the New York Times, the LA Times, and People magazine. And one of the things that's very interesting about Ruth is she is on a panel or a group working with the SEC regarding crowdfunding, and she can talk about that maybe a little bit later. So we also have Mr. Paul Winkle here. Paul is with Navocate. He's got about 28 years' experience in financial services and consulting. He has participated in dozens of IPOs with the licensing that you can see here, and previously managed 5 Series 7 offices. So he has a lot of experience in the securities realm. And Paul, I'll let you just
we also
do the
have
honors
Carl
for me.
Buell, who is the owner of Navocate, and Carl is, as you can see, a Fortune 50 executive management experience. Was an advertising executive with clients such as General Mills, Pillsbury Wrigley's, and McDonald's, and also a former Microsoft executive in charge of business development, international marketing, and government affairs. And Carl, I believe you had the pleasure of meeting Mr. Gates several times in your career.
Well, I had that opportunity, and that's another webinar with different stories, but I'd be happy to do that at some time. Thank you all. Again, let's talk about our topics here. We're going to talk about crowdfunding for issuers, and that's going to be covered by Paul, who will also cover the Jobs Act. And the Jobs Act is jump-starting our business startups. So it's somewhat related to jobs, but it's primarily focused on startups. And he'll talk specifically about the Title III regulatory update, which just happened earlier this week. Title III is the section of the Jobs Act that speaks to crowdfunding. After Paul, we'll have Ruth talk about eligibility and reporting requirements, and then followed by Maurice Lopez, who will discuss how to position your company to receive crowdfunding capital from the perspective of a crowdfunding platform. And then I will talk a little bit about how to value your company and set an appropriate share price, followed by the Q&A. So that's where we're going. Why don't we get started? Paul, I am just passing control over to you, so you should have control now.
I do. Thank you, Carl, and welcome everyone out there. There are a lot of aspects to the Crowdfunding Act, the Jobs Act. We're going to be talking specifically about Title III of the Jobs Act, which is specifically for crowdfunding, and we're going to be concentrating mostly on issues concerning the issuer today. So what is an issuer in the eyes of the regulators? An issuer is a legal domestic corporation offering securities for sale to investors for the purpose of financing its operation. And in order for a company to offer equity securities to investors, it must be incorporated. And that's what we're going to be concentrating on today, is the equity crowdfunding portion of what's going on in the United States right now. There are many different types of crowdfunding, but equity crowdfunding is the process of raising small investments from a large number of individual investors in return for company stock. And that's what differentiates it from other types of crowdfunding that you've probably heard of before, like Crowdfunder or Indiegogo. There are donation-based, reward-based, revenue model, and also pre-purchase models, as well as equity and debt-based crowdfunding. What I want to go over now are some issuer securities exemptions and how it applies specifically to the issuer, to the company. Now that you know the new terminology, an issuer is now an entrepreneur or a business owner that would like to crowdfund, and you now know that you have to get incorporated to be able to do that. And the reason for that is you have to be able to offer securities, stock. So let's talk about some of these things here. To be able to crowdfund and offer securities in exchange for monies, you have to meet some rules and regulations. Now, these are still being approved, but this is what Congress has set forth for the SEC to take a look at to pass final judgment on those rules. There is an aggregate funding limit which have to be followed. And to give you an example, the amount of monies that are raised from all investors can be no more than $1 million over a 12-month period of time. Also, individual investor limitations must be met. So what we're talking about here are not accredited investors. Some of you out there are probably very much familiar with that. Accredited investors are those investors that have a net worth in excess of $1 million, not including their primary residence, and or have made in excess of $200,000 over the previous 2 years. We're talking about non-accredited investors, and that's what crowdfunding is all about. The SEC is going to be ruling on what Congress has put forth and enacted into law through the President. And I'll give you an example of what's out there right now. This might change, but if you are raising money from a non-accredited investor, if that investor's income or net worth is under $100,000, they are limited to putting in $2,000 or 5% of their annual income or net worth, whichever is greater. If the non-accredited investor makes in excess of $100,000, then they're allowed to put in 10% of their annual income or net worth with an aggregate total amount of $100,000 put in with the total. That's if their income is in excess of $100,000. Another criteria for you to qualify to raise money from non-accredited investors is that the transactions need to be done through a broker-dealer or registered funding portal. Now, another term that you're going to be learning here is the registered funding portal is also called an intermediary. If you ever read through the Act, that's what the regulators call registered funding portals. So you just cannot go out on your own and start raising money from non-accredited investors. It has to be done through an intermediary who is considered either a broker-dealer or a registered funding portal. One of the other things that you'll need to comply with that's in the Act that the SEC is ruling on right now is under Section 4AB. You need to come under the requirements for issuers. Now, this is going to be something that we'll be exploring in greater detail in the next section that Ruth will be talking on. Let's go over some crowdfunding facts for those of you that are not too familiar with the term. It was signed into law by President Obama on April 5th. It is not yet active under the federal securities laws. So in other words, the SEC must adopt rules to implement the crowdfunding exemption. And the SEC has a lot of latitude in the Act to prescribe additional rules and requirements. And so they can require such other information by rule for the protection of investors and the protection of the public. What I'd like to do now is go over some regulatory updates. This past Friday, the SEC's advisory committee met, and it's the Advisory Committee on Small and Emerging Companies. And
Excuse me,
Paul. Affair, and I was able to listen in to most of that, and there are 6 different titles in the Jobs Act. Title 3 has to do with crowdfunding, and I am just going to go over Title 3 crowdfunding as these updates apply to issuers. One of the things that they talked about was a definition of crowdfunding and how they see fitting it in to capital access. And the SEC views crowdfunding as a new and involving way for small ventures to raise capital over the internet when registration, which means if a company decides to go public, they would have to file a registration statement. So when registration is not a viable alternative, and other exemptions, such as private placement rule 506, are not a perfect fit. Title 3 of the crowdfunding exemption is tailored to this specific type of capital formation. One of the other things that they talked about was funding hierarchy. Now, they commented on crowdfunding and the life cycle of the company's fundraising activities. They see crowdfunding, the hierarchy, falling in somewhere in between raising money from friends and family, which is a big part of the way smaller businesses sometimes start out. They'll hit their credit cards to fund their business initially. They'll go to friends and family. So it falls in somewhere in between that and the next round of financing, which is typically an angel investor or a VC firm. One of the other things that they talked about in great detail was SEC rulemaking. Now, the deadline, people are wondering, when can I start crowdfunding? Well, the deadline is 270 days from the enactment of the Jobs Act. Now, that was signed into law on April 5th. So sometime, if you do your math here, sometime in the beginning of January is when the SEC is supposed to have everything figured out as far as getting the rules in place. Now, this will include the time that the public has to comment on the proposed rules. So it won't be too much longer before they'll start putting some proposed rules into place and they'll put it out for public comment. They did say that they have teams in corporate finance and in their trading markets division working on the rulemaking as of this particular moment in time. Now, they still need to address specific issuer reporting requirements. They will take into account some things such as disqualification provisions for bad actors. That's another term that you'll become familiar with. Bad actors are those people that are attempting to run companies that have in the past violated securities laws. So they will have laws in place to stop that from happening. Also, they touched on 12G reporting requirements, which exempts crowdfunding shareholders from being included in the threshold on the number of shareholders a company can have before they're forced to go public. That was a rule that was in place before. I believe it was once a company raised money from 500 investors and had 500 shareholders, they were then required to go public. Not only did they raise that to 2,000 people, but anybody that puts money in via crowdfunding is not included in that calculation. Now, here's some of their concerns I'd like to go over, and these are some of the things that we're going to be touching on through what Ruth and what Maurice has to say. Liquidity issues. The current resale rules under crowdfunding, the investors have to hold their investment for 1 year. They are allowed to sell the securities prior to 1 year to an accredited investor back to the issuer, which is the company issuing the shares. If it's part of a registration statement, in other words, if you're lucky enough to be involved in a company that's decided to go public prior to the year being up, then you would be able to sell your shares prior to that 1 year limitation, or under certain circumstances you can sell it to a family member, and some of those reasons would be death or divorce. They do have concerns about how to handle any secondary markets which may develop. In other words, is there going to be a way of trading these securities in the private markets prior to a company going public? And those are some of the other things that they'll be putting out their answers to for public comment. Another important issue, and I want to slow down here a little bit because this is extremely important, is deal structure and valuation. The Act currently states that issuers are required to disclose how the securities are being valued, and you have to give examples of methods for how such securities may be valued by the issuer in the future, including subsequent financings. I'll explain that in a moment. Let's keep going. The Act also states that the issuer, you the company, must also provide the price to the public of the securities or the method for determining the price. Now, a couple of people at the meeting mentioned their concerns about this, and just a synopsis of it states that the SEC is concerned how the initial crowdfunding offering will be structured so that the issuer, you the company, can still attract subsequent rounds of capital from more sophisticated investors. So the deal needs to be valued as not to deter follow-on investments. Some suggestions were to allow third parties to provide diligence services as a way of linking the issuer and the intermediary. I'm sure Maurice will be going over this, but as an intermediary in the funding portal, they're not allowed to perform this due diligence. And one last thing I'd like to touch on here is another one of their concerns were the costs and risks involved with crowdfunding. They're concerned about the cost to the issuer to ready the company for crowdfunding. It is complicated and it can be costly. It includes legal and accounting fees, preparation of financial statements and corporation costs, writing your business plan or at least an executive summary, paying for evaluation on the company, which was that last section I just went over, developing your website and maintaining a social media presence, as well as ongoing costs associated with remaining compliant with the rules and regulations. In other words, they were concerned about the barriers to entry for smaller companies and how much is it actually going to cost a company to get to the point where they can get onto a portal and raise some money to grow their business and eventually create jobs, which is what this whole act is about. On a more positive note, several people that are in touch with the public, both issuers and intermediaries who are the funding portals, have said that there is incredible excitement from the issuers surrounding crowdfunding and the potential access to capital. So that concludes my portion of the presentation, Carl. If you'd like to take the ball back.
Sure. I will actually See, WebEx has this system where you pass the ball. I'm going to pass this over to Ruth, but Ruth, before you start, I think, Paul, you mentioned some important things that have a lot to do with why we're getting together with all of these different companies today. Although this is opening up investing to the general public for equity in small companies, this is still a relatively complicated process. It's not just a process of going to the platform company, filling out a form online, and you're off and running. You have to provide a lot of information in order to do that. And part of that is getting all of that information together and organized. So that's where I'd like to pass this over to Ruth. And Ruth, you can talk about how Crowdfunding Roadmap provides some of those services.
Sure. Do I have control of the screen?
You should.
Okay. So if I close down this, you'll be able to see my...
You have to go share your desktop.
I have to go share my desktop. Okay.
There we go. It's happening.
Okie doke. Great. Beautiful. So thank you all for joining us today. We're all very excited to be a part of this new industry. Many of us worked several years to get this bill passed because we passionately believe in the power of entrepreneurs and startups, and we wanted to level the playing field for access to capital. Now that we have accomplished that, the big challenge ahead of us is to make sure that the entrepreneurs that need the capital are prepared well ahead of time to be able to launch next year with intermediaries on funding portals and to be able to successfully raise the capital that they need, and then obviously to run a successful business. So what we did is we put together a website called Crowdfunding Roadmap, and we put the information along with the resource partners to be able to help entrepreneurs accomplish this goal. And if you go to the homepage of this website, you'll actually see the requirements, the SEC reporting and registration requirements. I'm just going to briefly go through them, but you can all, come back to this page and review it yourself. But basically, first of all, you need to be incorporated in the United States. You need to have an address and a website. You need to have a list of all the directors and officers who own more than 20%, a description of the business and the anticipated business plan of the issuer, prior year tax returns, and financial statements. These financial statements are very critical to the success of this and to be able to actually register. Companies looking to raise $100,000 or less via crowdfunding can provide financial statements that are certified to be true and complete. This is the kicker. They have to be complete by the officers of the company. And you can sign them yourself like you would sign your tax return. And that's so you're self-certifying that they're accurate. If you want to raise more than $100,000 but less than $500,000, then you have to have your financial statements certified by an accountant. If you want to raise more than $500,000, then they have to be audited financial statements and actually prepared by an accountant. You also have to have the description of the intended use of the raised capital and proceeds, the target offering amount, the deadline, and regular progress updates through the life of the offering. This is really important. Every year after a successful crowdfunding offering, the issuer must file with the SEC and with investors reports of the results of the operations and the financial statements of the issuer. So creating documentation that can be easily updated and kept current is very important to the success of this. So we put together, a partnership with an accounting firm to help our entrepreneurs do this, and with an organization, a company called Laughlin that does the incorporations. And then we built this reporting system. There's a lot of information that you need to compile. It has to be absolutely accurate. you are signing off on the validity of this. You have to be able to defend what you're saying about what you're going to do if you raise $1 million, and you have to be able to explain it to potentially hundreds of investors, or maybe even more than that. And then you have to be able to continuously keep them abreast of the progress that you're making with their money and with the development of your business. So all of those fields that you saw, all the information that was required in this list, we created a reporting system on the cloud where all of these questions, you can answer all these questions and basically create a placeholder for this information so that when it's legal to do so next year, you'll be able to go to a funding portal like Early Shares, and you'll be able to provide this information. And even if you have to copy and paste it from these forms, you'll have compiled it. And that's a huge, huge part of this process, because there is a lot of information that you need to be able to put together. And this way, in this type of format that we built, we make it much easier for you to be able to do this. In this type of reporting system versus a business plan, 50% of the questions are multiple choice. So there's these drop-down menus which allow you to easily compile the information. And then you can invite investors and lenders in the SEC and the funding portal, whoever needs to review this information.
Ruth, are you there? Hey, Paul, do you hear Ruth?
No, I don't. I think we might have lost her.
Yeah, it sounds like we've lost her. So here's what we'll do. I will take control back, and Paul, maybe if you could get a hold of Ruth, we'll go to Maurice at this stage, and then we can come back and maybe pick it up where Ruth left off.
Sounds good. I'll give her a call.
Okay, thanks. So, Maurice, given our live technical difficulties here, we're going to jump back and let me introduce Maurice Lopez from Early Shares. And Maurice, why don't you take it from here?
Hey, guys. Sorry, I think if Ruth comes back, I'll let her continue. I'm kind of setting up over here as well, so I wanted to get some screenshots ready for you guys. But actually, I wanted to cover a couple of things. I think Ruth is absolutely correct that the more organized you can get with your documentation and tools like hers will help any startup get their ducks in a row, per se, because the biggest challenge people will have with crowdfunding will be transparency. And the more transparent they can be with their financials, with their business planning, with their overall company outlook, the easier their funding process is going to be, both from getting it getting it started to getting it funded. And having that attitude of transparency, that public company attitude from day one, or culture, let's say, will definitely ensure a successful campaign and ensure a successful business. I think the biggest challenge people will have is understanding that now they have 1,000, 2,000, 3,000 shareholders, and that comes with a certain amount of responsibility to provide transparency, to then provide financial statements, provide updates, and I think I would say that's probably the biggest challenge small businesses will have, especially if they're existing small businesses. Do we have Ruth back at all, or we're still? No? Okay. Well, I can talk a little bit about what's going on with Early Shares. We are in the 270-day waiting period like everybody else, so we're perfecting our platform. We're adding features. We're working with entrepreneurs that have applied and helping them coordinate them to the right partners to get their ducks in a row. One of the very important factors I think to consider here is companies like Navocate, who can help you with the valuation process, companies like the funding roadmap that can help you with the documentation process. So when you come to a platform like ours, you've got all the pieces for successful funding. And I think that's probably the most important piece of information you can take out of today's webinar, is having all this information correctly formatted, correctly put together in a way where the investors will be able to see. Remember, the investor now is not your accredited, sophisticated investor. The investor is your friend's friend, the guy who works down the street at the laundromat who has $100 to invest in some company he understands or would like to participate in. So it's bringing it down to that level of unsophisticated investor to explain your business. You might understand your business, but the guy investing $100 who's supporting your business, does he understand it? Did you pitch it across in a way where everybody can get it? And that's really important as well. From the rulemaking process, if you want to talk a little bit about SEC, I think they're doing a great job considering the limited resources they have. We've been actively involved with helping provide any kind of guidance we've received from the public, from the companies, back to the SEC, which in this rulemaking process, they're looking for as much information from the crowd and the intermediaries as much as possible to help them make this process easier. Because again, they're used to dealing with very restricted guidelines in a typical broker-dealer environment, where this is not, this is completely new to them as well. So I will say that we have nothing but great experience so far, and unlike our expectation were that they were handed a hot potato and this wasn't really something that they really were excited about, and it was to our surprise they were very excited about it, and they were very interested in making this work and benefiting from the fruits of this, which will be eventually, companies and new jobs. So everybody's pretty excited, and I think it's going to be an incredible 2013 for not only issuers or companies looking for money, but for the general investor population, the new investor class, as we call it, that will participate in these great little companies, and hopefully they won't be very little for very long. Let me see if I can share my screen with you guys. I wanted to, let me see, 1 second.
You have control up at the top?
Yep. Do you guys see the Early Shares website?
It's coming in, but we don't actually see it yet. We see a blue screen. We see your cursor. There we go. You popped in.
Okay. All right. There we go. All right. Well, obviously this is our website. For those of you can visit URL directly. But what I wanted to show you was actually once a company applies for funding. For those of you who haven't done this already. We'll just create a username here, and let's see if we can actually. Oh, okay. Sorry, guys, I wasn't ready for this just yet. Okay, a little bit about our platforms. I can get an idea. When you're logged into our platform, you can be either an investor or an entrepreneur. You can have your businesses or your investments. In this particular case, I want to show a little bit of the. Hopefully, in this account we have some things in it. No, we don't. Okay. All right, let's go and look for investments. These are sample companies. One of the things that I wanted to cover today is that Paul touched on in the beginning a little bit about the rules are not in effect yet, and we see a lot of companies out in the market actually displaying company names and putting out information about companies listed on their portal, companies that are applying, and then not having a button allowing them to invest. The SEC is being very adamant about not allowing that. We're not until the 270-day period ends. We're still under the current laws of the SEC. That means that general solicitation still applies. If you put a company name out on your website that that company has a description, has ABC Liquor, and there's even though you don't have a button that says invest in it, that company is still violating the rules and the law, for that matter. Because a smart person can just go to Yellow Pages and look up what that company phone number is and call the CEO and say, look, I see you're looking for money. Let me invest in your company. So therefore, you're circumventing the rules and regulations. So again, we've got fictitious company names here. Even though we have about 500 companies that have applied for funding already, we don't list any of them on here just because we want to be playing by the rules. So when you come to our platform, you'll be able to see companies that are looking for funding. We offer a number of different funding options for most companies, from straight equity to equity plus a dividend, from equity plus a dividend plus a perk. Perk meaning a product. So if you have an organic dog food company and you're seeking $250,000 in funding, part of your pitch to the potential investor might be invest $250 in my company by buying one share, and I'll send you a bag of dog food, of our organic dog food. Invest, $2,000 in our company, and I'll send you, a case of 6 bags of dog food or something on those lines for a year. So that's where the perk comes in. It kind of motivates the investor to be more active with your company. And I think one of the big things that will come out of crowdfunding, more important than the money aspect of this, which is the initial funding that startups need so badly, the funding gap we keep talking about, is the fact that there's 2 other very strong benefits that I would say probably equally as important. One is the validation of your product, concept, or company, which comes from the successful raise. If you've got 2,500 people that bought into that organic dog food company, and especially if it was in a very short period of time, you've got a substantial validation that there's a need in the market for organic dog food. Secondly is your marketing reach, or we call your following. This is very important. So if you're starting a company with organic dog food, you've got 2,500 investors who each put up $100, or 5,000 people put in $100. You've got now 5,000 loyal customers that are not only investors in your company, but they're probably customers of your company for life. As long as you don't do anything wrong with your food, you don't kill their dog, they're going to be buying your dog food. They're going to be telling their neighbors and their friends and their parents and all their family about how great your dog food is and how excited they are to be a small owner of your company. So the marketing angle of crowdfunding as a support structure is huge. I would say probably even more important than funding. I mean, we have companies that have come to us in the last 90 days that are very successful companies that have got 120. The one company I can mention has 120 employees and is in a major metropolitan city, and they provide a service to thousands of people. They're probably $3 to $5 million in revenue, and they're looking to crowdfund just to convert their company in from a privately held company to a customer-owned company. It's kind of a spin-off employee-owned company, and I thought that was a great idea. They want to engage with their target audience, which is their customers. They want to offer all their customers a small equity piece in their company, so they have that customer retention from the factor, avoids them losing that customer. Somebody comes in and offers it for $1 cheaper or whatever it is. So they've got that engagement going on. I thought that was very creative, and I think we're going to see a lot more of those type applicants in the industry as a whole. You'll see people that are successful businesses, successful small businesses that have revenues. About 65% of our applicants are actually companies that have revenues and a couple years in business, if not dozens of employees. It was surprising. We thought it would be around 90% true startups with business plans, and that wasn't the case at all. Again, when you come into a company, you'll be able to see some very basic information about the company without signing in. And once you sign in, you get to see a little more information. So here you would see, how much the company is seeking to raise, what equity is offered, what category they're in, what their location is, their company website, phone number. These are all requirements. And the reason we list this, and originally on our platform we didn't have phone number and website because we didn't want people calling the owner of the company and saying, "Oh, I just saw your company on early shares, and I see you're looking for money. Tell me more about your company." Imagine if you have 5,000 people calling you. But unfortunately, it's a requirement in the bill and in the law. It was, the contact information of the company has to be listed, and it cannot be listed only after the investment. It has to be listed before the investment. So not only our platform, but most likely everybody's platform will have to have that kind of compliance in one way or another. You'll have the information about the company. This is where it'll cover all the different areas, and this will be imported directly from, can be imported directly from software like Roof Funding Roadmap, where it'll populate these fields automatically with your extensive business plan, and you share what you want to share. But again, understand that this is just like a prospectus from a public company, in essence, that everybody will be able to see this. So there's a certain amount of fine line of where you want to put your secret sauce, per se. If you have a very competitive business where your competitive advantage is information of some sort, then you might want to, consider, what you can put out to the general public and what you don't put out. So, because everybody will have access, including your competitors. So there's a certain amount of caution to be done there. Additionally, we also encourage most startups that are truly a product-based, concept-based endeavor to file for at least a provisional patent. And we have a resource section of our website, which will be coming up this week, which has a number of third-party companies that are in all across the country that have can provide you with patent searches and patent filings, and at least provisional patent filings, especially if you have a product-based offering. One of the cool things I think about our where is it? Our platform, which is kind of embedded in the law, but there's different ways to interpret how this will. Sorry, my screen's not refreshing fast enough here. Is the fact that you'll be able to communicate with between the entrepreneur or the business owner and your investor, your crowd, your following, okay? Because it's very important. One of the big advantages everybody always says about, and I've experienced this firsthand, where you've been, you had an investment from a venture capital group, or let's say influent people, an angel group or something like that, is that they do really bring something more to the table than just money. And that a lot of times is experience, which, the mentoring part comes in. And secondly, it's a lot of times, most importantly, is the contacts. That contact might be a manufacturing contact. That contact might be a distribution contact. That contact might be, a human resource aspect of your business that enhances it to the next level. Or more importantly, the next round of funding, because they have those VCs on a personal basis, a contact basis. This kind of was something a lot of people were concerned about in crowdfunding. Was like, well, you're not getting that mentoring, you're not getting that, you don't get the value add that a VC brings to the table. And I think that's kind of like small thinking. As a matter of fact, I think you have more access to those things. So now, if you've got 2,000 or 5,000 people on your shareholder base, you now have 2,000 or 5,000 people that have great contacts, and they have ownership interest in your company. They know somebody who is a benefit to your product or your service. They're going to put you in touch with that, and they're going to send you an email, or they're going to go on your updates here, or go on your investor portion of the page here, and basically send you that information and try to get you engaged in that information. And that's going to bring, and that's where I think that you get the same kind of values you do from a private equity or VC or an angel investor type. I don't know what else I can actually show you on our platform. Let me see if I can go back to the slides, talk a little bit about early shares. Let's see.
Maurice, you want to stop here? I can come back just a minute. Okay. I'll bring you back. Hold on. Okay, and let me now pass the control.
Well, we had a quick. I'll jump through.
Here you go. You're on.
Yep. Perfect. I'll jump through a couple of these real quick. This was obviously, we covered some of these things already on the presentation, so I won't bore you with the same information. These are timelines that has happened. Again, we're in that 270-day project rulemaking period. This covers some of the things I talked about: critical information, the community. Besides money, we bring that following, we bring that marketing efforts, online exposure. And, something that we haven't talked about, either Ruth or Carl or Paul talked about, and is, how expensive is capital? If you look at what we're offering people what we're offering entrepreneurs, the ability to raise $250,000, $500,000, even $1 million in some cases, and charge them a fee of, it's going to be transaction. It's not going to be transactional or percentage based now, according to the SEC. It'll be a flat fee kind of service. But let's say it equates to somewhere around the vicinity of 5 to 10% of the amount of money raised. If you look at that, that's actually a very inexpensive way to raise capital compared to if you were able to get that money from a bank. Interest rates right now from a bank, if you're an existing business with a couple of years and very good credit in a commercial loan, unsecured, it's still in the 10% range, if not higher. If it's secured debt, then it gets a little bit cheaper, but it's still pretty high up there, and that's every year until you pay it off, and usually it's a very long term. So in essence, it can end up being 30, 40, 50, 60, even 100% of the original amount borrowed, compared to a flat fee for equity of let's say it was in the high end 7 or 8%. It's very inexpensive capital, especially because you don't have to pay it back, and your investors are going to get their return on investment based on a dividend payment or based on an acquisition or a liquidity event in the future that everybody benefits from. So it enables you to do what you want to do in a very inexpensive way. I mean, we talk about inexpensive capital. It's something we're very excited about. We always, it's built into every piece of media we talk about, because this is the first time people even have the opportunity to do something like this. Let's go to the next slide. What do we got here? We're very, Early Shares is very concerned about the industry. We're very, pro-industry. We're a member of both associations. Actually, the other one's not on here. It should be on there. We're actively engaged in the community. We want to help out competitors. We think there's plenty of business out there for everybody. There's no single portal that will be able to handle the hundreds of thousands of companies that will need funding. So we're out there to share our knowledge, and we want to participate with everybody. Our mission is connecting investors to entrepreneurs, which is kind of self-serving. Our team, there's a lot more people involved in our company, but these are our owners, our 3 major shareholders. We have a staff of about 19 people right now, and this is all we do. We've been working very diligently on the back end and the documentation and everything else that goes along with this. This is not a business for people that believe that it's just you throw up a website and a template and a widget, and all of a sudden you're a crowdfunding platform. I mean, we've spent hundreds of thousands of dollars on legal fees. We have, and we're at the beginning of this process. So there's quite a bit of background in the staff, and we have a huge legal team and a support system for our companies coming on board. We do shareholder management. We do help them with their videos. We do quite a bit of stuff that not all of it I can talk about. Why early shares? Obviously, management. We believe that companies will come to where the money is. So we're very focused on creating investor protection for the shareholders. So creating easy investment opportunities where we take care of a lot of the protection, we take care of a lot of the due diligence, take care of a lot of the factors for them to make their investment decision very simple. With that said, we've partnered with companies like CrowdCheck and Navocate to make that process even more streamlined. The companies will come. They'll follow wherever the money is, kind of thing. A little bit about us. We've been in the spotlight a lot. We were featured on the House on Startup America the day the president signed it into law. This is for those of you who don't know, Startup America was created in the White House. It's an initiative to create jobs in America. It's a foundation, nonprofit that has a tremendous amount of success and impact in the economy in the last year or so. And if you're not a member, I highly recommend you join. It's free to join, and they have some very, very good free services and benefits to startup companies that you would not get anywhere else. And it's actually pretty much, it's very awesome, and it's free. Well, I don't know if we can talk about this. This is fun. We talk about this again in-house a lot when we make presentations and our investor meetings and stuff like that about funding gap, what's going on in the economy. There's obviously this is kind of a no-brainer because we all wouldn't be in business if banks were lending money. This is kind of a cool factor. We came across some data out there, and there's $30 trillion of funds that are uninvested by the average American that's out to be invested in crowdfunding. And we've taken some of the little successes of Europe into consideration as well. Our users, again, this is for those who are new to this. We have, we don't particularly focus on any kind of demographics. We are a platform for all kinds of companies. We not discriminating or selecting any kind of particular vertical. We allow anybody to invest as long as you meet the criteria set forth by the SEC, and same thing with listing companies. As long as you meet the right due diligence criteria within our platform, which is available on the site, then you're accepted into the platform. Our crowdfunding process begins with an application. We do screening. We do a number of background checks, and this is where we work with CrowdCheck and our own internal due diligence process, and we check out the company. We do the vetting process at that point. Once we do, they pass the preliminary analysis portion of this, then we actually go through a more intense due diligence process. Then it goes live. Campaign actually starts. Company then has to engage there. And it's a very important thing to cover as well. And this is something I'd like to mention that I haven't heard mentioned very often. The concept behind crowdfunding and the reason it will work, and for some people and it won't work for others, is you have to understand that in order for it to work, it really needs to come from your connections. You have to get that first 30 or 40% of the funding in your campaign from your crowd. These are your Twitter, Facebook, email, your friends and family. The general population in the past, at least with the non-equity-based crowdfunding platforms out there, don't jump in to a project that does not have already hit that pivoting, that tipping point of about 30%. So, the people that think that I'm going to raise money for my idea or my company and I'm just going to throw it up on a platform and then it doesn't work and they blame the platform for it, didn't do justice to themselves because they didn't do the work. it's not. I don't think it's going to be necessarily easy for anybody. I don't think it's going to be extremely difficult or impossible. I think there are going to be a lot more successes than failures in the reaching their funding goal. Kind of once you're accepted into the platform, but it is work. It's not you get listed and you're guaranteed success. You've got to do the work. I think I can't emphasize that a lot more because we've been talking to a lot of the companies that are in Europe, and we see what works and what doesn't work. And we've noticed that the companies that are engaged and active and really out there pitching their company are the ones that have the most success, which is really cool. We do some follow-on work, which is the shareholder management piece of this, which includes managing the shareholders, which is a big piece of this because no single business owner wants to go out there and have to communicate on a regular basis, quarterly or semi-annually, to 5,000 people. So we've actually made some processes in-house that make it very easy for the shareholder. For the entrepreneur to communicate with the shareholders, keep them up to date, keep them up to speed, provide reporting, provide tax documents at the end of the year, and so on and so on. And lastly, where we come in and fit with Navocate as well is that we partner with them in a way to facilitate the exit and the liquidity event for these companies is where the shareholders get the most return on investment, which is the M&A portion, or if they're lucky enough to have an IPO or some sort of private equity acquisition. But that's where Navocate comes in and helps us. And actually, they come in early on in the game where not only they help with the evaluation process of the companies, but also identifying a I say roadmap, but it's a roadmap from that's Ruth's company name. Kudos to Ruth. From point A to point Z, coming in, this is what I'm getting, this is my objective, I need this money, I need this following, I need these customers, this is my marketing effort, it's all wrapped into one package, but here's my plan to get to the exit, and that's where Navocate comes in and brings a lot of value to the table, where they can actually guide the company from the beginning and saying, okay, well, if you're a catch-up company and your plan is to get bought by Heinz, then you need to be in 20,000, store shelves by, 12 months and 50,000 store shelves by 18 months, and then I'll get you in front of Heinz and, we'll get you acquired. But, there's a process and there's milestones that have to be met along the way, and these are, so they help us guide that company to the right path so they're more successful and it creates a liquidity event for the shareholders. I think that's that's the last slide I have for you guys, and I hope you enjoyed, and I'm open for questions towards the end here.
Right, great, Maurice, thank you. We have Ruth back, and actually she is back through a link to Paul's phone. So Paul, can you hear me, and Ruth, can you hear me?
I can, and Ruth, go ahead. Can you hear us, Ruth?
Yes, I can hear you guys.
Yep, you're good, and we see your screen again.
Okay, terrific. So what I wanted to go back to the due diligence process, because this is really the difference between getting funded and not getting funded. And I don't think that enough people, when they're writing a business plan, that they understand the importance of compiling all this due diligence information, because it really doesn't matter whether you're crowdfunding or you're going to a bank or you're talking to a group of angels or VCs. You still have to disclose the financial condition of your company, what type of corporate structure you have, registered agent information, shareholder lists, the financial book of accounting, your tax, information about when your tax returns, insurance policies, any criminal proceedings, bankruptcy petitions filed by principals and affiliates. This is all going to be required for you to disclose during the crowdfunding for equity process. Any copyrights, trademarks, patents, all this kind of information is going to help you to impress upon the world of investors now that they should invest in you because you've done this work and that you've protected the copyrights and patents and trademarks of the company ahead of time so that their investments put in the hands of the right people. And then as far as the financial statements, since you are going to be required to provide financial statements, we've built a very simple and easy way for you to create these financial statements. They're GAAP compliant. All you have to do is put in the raw numbers, and then there's a button at the bottom that says Save File, and it automatically does all the calculations for you. So if you do have to go to an accountant, this will reduce the cost dramatically from what you would have to pay if you had to pay them to create them from scratch. And then another feature is video. In a typical business plan, it's a PDF or Word document, Excel spreadsheet. You don't have the ability to showcase your product or prototype or an interview with your management team on a typical business plan. So having a cloud-based reporting system is just critical to all of these kinds of things. And I also wanted to make a point. I'm going to be really short because I know that this has gone on longer than the original time frame. So, but I do want to talk about your ability to build a crowd, because at the end of the day, it would be a terrible shame to go through all this time and expense to get prepared, to get incorporated, to get certified or audited financial statements, and then not have the ability to actually go and have a crowd of people. And things, for example, like Twitter, a lot of people don't understand the value of Twitter, but like, for example, this is one of our Twitter accounts, and we have 31,000 followers. If we were going to crowdfund, we would immediately have 31,000 people to talk to, and they could retweet our tweets, and there's 300 million people on Twitter alone. So just imagine the potential. So I would recommend to anybody on this phone call that's interested in crowdfunding any kind of way that they immediately start building a crowd, because it's absolutely critical to the success of this entire process. And also, after you've gotten funded, you want to be able to build your business so you can start selling your product through the crowd that you built as well. I also wanted to point out that Navocate is a partner of ours too, and that we are very excited to be working with them, and recommend that everybody uses their services, because obviously you have to be able, if you're going to create a value for your company and share price for your company, you have to be able to defend it. That's part of the law as well. And I think that was it. So I just want to thank you all for inviting me to be on this.
Okay, Ruth, thank you very much. Please stand by. I'm going to cover our services here and how they fit in just very, very briefly, and that is the valuation component of it. Paul mentioned before that when you value a company and when you set a stock price, you have to define what your methods of valuation are. That's difficult for an entrepreneur who isn't looking at doing that every day. So what we have done is we've created a valuation model, but I'd like to talk just quickly before then where we fit in. This is a matrix of intermediaries and company sizes for M&A activity. Navocate fits in a sector that we call emerging companies, ranging from $3 to $30 million in revenue. And the reason we focus there is that that's a very entrepreneurial sector. It's certainly larger and more difficult issues than a Main Street company, but not quite as complicated and complex as a larger corporation. So if you're in this emerging company range, you're likely too small for an investment bank, and you're likely too big for a business broker. And that is the niche that we focus on. Our valuation model is, as I mentioned, was created from scratch, really. And the reason for that is because we didn't like what we saw out there. We were dissatisfied with the alternatives. We didn't like the fact that the numbers were buried in the commercial software. We didn't like the lack of flexibility. We didn't like the errors in the methodology that we were seeing. So we created a model, and I want to position where we are on this relative to other valuation services. So let's take a look on the left side. On the y-axis, we have a cost ranging from low to high. At the bottom, we have, on the x-axis, information ranging from less to more. And on the second y-axis, we have time ranging from days to weeks. I'm not going to go through all of the different valuation services available out there, but to start, up at the top right, there's this certified appraiser. Now, it's important to know that when it comes to valuation, there is no regulation. There are no federal laws. There are no state laws. So what you have is a group of associations and appraisers become certified. Up at the top, you're in the high cost, long time, and a lot of information section of the graph here. So this is going to range between $6,000 and $10,000. It's going to take 6 to 8 weeks. These folks can do litigation support, and they are used for loan substantiation. At the other end of the scale, we've seen online valuation services pop up, and this is pretty automated. It's fill out the form. We'll charge a couple $100, and you'll get your package in about FedEx in 3 to 5 days or so. Navocate positions very differently. We position in the moderate information and moderate cost and relatively quick time frame. So our valuations range between $500, $1,000, and $2,500, depending on the stage that the company is. And generally, this takes about a week of time for us to prepare the valuation. But more specifically, what we've done here is very specific to this entrepreneurial area. The certified appraiser can't really operate in this range because they don't look at it how we look at it. And certainly the online guys can't operate in that range because they don't look at it how we look at it either. And let's talk about that right now. So we tend to look at business in 3 stages. There's the pre-revenue stage, there's the revenue but no profit stage, and then there's the revenue and profitability stage. Each of these companies are very, very different in how they need to be analyzed and how they need to be valued. And again, we see them here. And my slide doesn't want to advance, so we'll jump there. We also look at 3 levels of analysis. We look at the sell side, the buy side, and specifically what we call the soft side. So the sell side is simply looking at how have similar companies sold in the past. We start with a database of approximately 650 industries. We'll look at the asset value, but that's not something that we render an opinion on. Particularly when it comes to real estate, where all real estate analysis and valuation is done on a local market level. So you can provide us with the assets and we can plug them in, or we can leave them out. But primarily we're focusing on the business. We also do sensitivity analysis when looking at the multiples. So we're not just coming up with one number. We're doing a lot of interpretive work to understand how the historical multiples apply, and do they even apply. When it comes to the buy side, this is analyzing the valuation of the company based on a buyer's perspective. And the most important thing that we look at there is the deal structure. And the reason that the deal structure is so important is because, yes, you have to look at how it's going to be financed, but you're primarily looking at what the objectives are of the buyer. What is the risk tolerance? What are his or her leverage preferences? How much cash available do they have to inject into the deal? This deal structure is very, very different than just looking at it as a sell side only, because it's forward-looking as opposed to historically looking. Once we have the deal structure and the sell side information, we run a series of projections, and we look at multiple deal-based combinations. Now, this is not, importantly, just a pro forma. We're looking at it at a very high level to understand and model different scenarios, and that's a very significant difference in our approach. We also have the soft side. The soft side is very interesting because not very many valuation companies look at what we call this soft side information. So here we're looking at the management structure of the company. Does it have financial controls? What's the size of the market opportunity? What kind of systems do they have in place? What are the overall risk factors? These are just some of the issues, but not all of them. These soft side factors are going to extend you on one side of the statistical curve or the other. They're going to make an average company much better, or they're going to make an average company much worse, depending on all those factors. So very quickly, we look at the 3 business stages, and we look at the 3 levels of analysis, and we're capable of providing evaluation in all of those cells. And that system is in final testing right now, and will fit into anything that you're doing, not only with crowdfunding, but general business valuation. So now, let's just finally open it up for Q&A. And Maurice, I've got your microphone open. Paul, I've got your microphone open. And we've had a lot of questions. Paul, can you take a look at some of those questions?
Yeah, I did. Maurice, I'm going to start with you because it looks like you just answered a question through the chat room. I don't know if everybody can view it, so if you don't mind repeating it. This one comes out from Scott. Can only individuals invest, or can, say, a city invest? And Maurice, would you just like to repeat your answer for everyone?
I believe, yeah. My answer was, I believe the question really depends on the city's bylaws and charter, because if they can invest in regularly traded stocks, then they can invest in crowdfunded stocks. It really depends. It's really, I don't think it's a federal level decision. It's really a city. You know, it depends on what their ordinance is or what their charter is. That was my answer. I answered the other question too, but I think I answered that one probably by accident. Scott,
also, I think that you mentioned in there that they would be considered an institution, so maybe they wouldn't qualify under the crowdfund exemption because of that. But we have to wait and see what the SEC's ruling is going to be.
Well, an institution can invest in the. Let me rephrase that answer. Okay, an institution. An accredited investor, an institution, anybody can invest in a crowdfunding round. There's nothing that limits who can invest in it. Whether it's an institution or an accredited investor, it just allows them to be unlimited amounts of the amount they can. There's no limit on how much they can invest. And additionally, when they invest, they go towards that 2,000 shareholder, whereas in a non-accredited investor falls on that unlimited number of shareholders.
Gotcha. Thank you.
There was the other question. You want to get that one, Paul? Well,
I don't know which one you answered. I'm just going to ask them as they come in here. First couple of them came in from 2 different Scotts, a Scott S and a Scott B. They're both very similar. Can nonprofits participate, noting they don't have stock to sell? I'm assuming they're talking about nonprofits as an issuer and not as an investor. And Scott B's question were do LLCs count as incorporated? What about S-Corps? My understanding of this is, and Ruth and Maurice, you guys can jump in, is that you have to be able to issue stock. That's the whole issue behind equity crowdfunding. So I don't believe that nonprofits would qualify, nor would LLCs, but I certainly do think S-Corps and C-Corps would qualify to become an issuer under the Crowdfunding Act.
Right, and there's donation-based crowdfunding that would maybe be more applicable to the
donation or reward-based for the nonprofit. Correct.
Right.
I have another question from
Can
John.
I add one thing to that one, Paul?
Certainly.
On the question from Scott about LLCs or versus a C Corp, S Corp, just keep in mind if you're going to register your company for funding, and if you haven't done the registration process yet, look into registering a Delaware C Corp. And the reason for that is we recently we do a lot of investments on the venture capital side, and we actually raised our own venture capital recently. And it is amazing the number of VCs that won't even look at your deal later on once you've gone through your crowdfunding, you've gone through the next stage, if you don't have a Delaware C Corp. And the reason for that is that the Delaware C Corp is the most favorable, simplest, cleanest state from all angles to do with corporate formation. So that's what most VCs standardize on, because that way they don't have to know every intricate piece of law in every single state around the country. So they kind of like they will knock out your deal. Even if it's slightly interesting to them, they won't even go any further in due diligence and looking at your deal if you're not a Delaware corp. And I was very surprised by it. And this is kind of something that's happened recently. I would say probably in the last 24 months. I've seen a lot of deals not get funding at all at VC level because they weren't a Delaware corp. So if you haven't done your incorporation yet, I would highly suggest look into that, talk to an attorney, because if your objective at the end of the day is to go through other rounds of funding and you're going to go to VCs, then you want to make sure you didn't kind of shoot yourself in the foot by just incorporating the wrong state or under the wrong formation.
Thanks, Maurice. Hey, Carl, here's one for you. John asked, will all these slides be made available?
Yes, excuse me again. Yes, they will. We are recording this session, and you'll have access to the video. We will also make all the slides available. There's a trade-off for that. We're going to ask you to take a very quick survey about this webinar. It's about 5 questions, and then you'll be able to download the PowerPoint in a couple of days.
Ruth, one for you. Brendan asked, how much does it cost to use the roadmap?
It's very inexpensive. It's $59.95 a year, and that includes, the secure storage on the cloud. And as many investors can access it that you want. And this actually goes to the next question, which Jim Golden put out, which is, we've discussed protection for investors. Can you help me understand how the business is protected from competitive access to information that could be proprietary? So we have a very secure system on Funding Roadmap, for example, where you create the password and login, and you decide who gets it, and then you can go in and delete them from the system at any point in time that you want, so they can't ever get back into the system. This is very important because what Maurice was discussing before, you may only want to put general information on a funding portal, but you obviously need to have the specific details of the actual plan and the product or the service that you're creating or offering. And so you're able to basically prepare all that information, and then you decide, once these people have invested in your company, that you'll then give them access to your full and complete plan and all this confidential due diligence information.
Thanks, Ruth. Hey, Maurice, why don't you go ahead and take that question that you're answering there. This comes from Kimberly, how are state blue sky laws anticipated to impact crowdfunding? There's a little bit of regulatory guidance still coming out on that one, but right now, the way it falls right now, as if it was today, is that the Jobs Act, being federal law, supersedes the blue sky and preempts the blue sky requirements. So if you're doing an offering under the crowdfunding exemption, as it's called, then you would not have to comply with blue sky laws. Thank you. And this one's from David. What are the anticipated requirements for being a registered funding partner? I'm assuming that is portal. And Maurice, I know you can answer all of these questions. I will just say this before you answer that. You can go on to EarlyShare's site and download the actual act and read the act. Go to Title III Crowdfunding, and there's a section called Requirements for Intermediaries, and it lists everything that you need to do so far to be compliant and become a registered funding portal. It's got mostly to do with looking out for fraud, doing background checks, and making sure the investors understand the risks, and questionnaires for the investors. Anything else you want to add to that, Maurice? I know it's a whole laundry list that needs to be done.
Yeah, it's a pretty big list. It's easy to read the bill. But basically, it'll involve a FINRA registration of some sort. It'll either be a broker-dealer light, as the SEC calls it, or it'll just be and even the licensed funding portal, as it's written in the bill right now, will probably be some sort of version of a broker-dealer light. This is definitely going to be regulated by FINRA, and it requires broker registration and quite a bit of steps. It's not for the light at heart, but it is. If you're already a broker-dealer, or if you're already a securities firm, then it makes it a lot easier. I think there's plenty. Again, there's plenty of market for competitors. However, I think there's so many businesses to do as service providers for this industry that, if I was starting from scratch today, I definitely wouldn't do a portal. I would do one of the auxiliary services. I mean, you've got a million things that can be done for companies seeking crowdfunding where your income potential is much higher than the limited fees that you're going to be restricted on charging.
It seems like you almost have to have a broker-dealer knowledge to act as a funding portal.
It wouldn't surprise me at all. In the next 90 days, they announced that you have to have a broker-dealer license. You have to have at least two members of your company licensed securities, brokers.
Randy has a couple of questions here. It's a follow-up about the LLCs. An LLC can issue equity as units. I don't understand the position that LLCs will not be able to participate, and units can be shares, including the ability to have multiple classes. I think this is probably best answered by an attorney, but I do know there are individual blue sky state laws that mandate who can and cannot invest in LLCs, and most of the time they have to be accredited investors. Beyond that, it's beyond the scope of my knowledge to answer that question, unless anybody else on the panel would like to take a shot at it.
Contact your attorney.
I would say contact your,
And don't be surprised if your attorney doesn't know the answer to that yet, because, again, it could be covered under the exemption. There's nothing in the bill that says it has to be a C Corp or an LLC or any kind of corp for that matter. It just talks about securities and how the security will be treated. It doesn't talk about what type of company formation it has to be, and so that's part of the guidance that they're working on.
Here's one. Only U.S. companies to receive funds. How about foreign investors in U.S. firm? I believe that's a no-no. I think the whole idea is to fund internally in the United States. But Maurice, you sit down with the SEC on occasion. Any input there?
Actually, surprisingly enough, they have no problem with foreign investors. They do have a big problem with foreign companies. You can't crowdfund a foreign company. It has to be a U.S.-based company incorporated in the U.S.
We'll take their money.
We'll take their money, If it creates jobs, we'll take their money.
Maurice,
all right,
what
and
if
I
you
believe you answered this one already, but for the sake of everyone else listening in, from Michael, are there any issues with an international listing and raising proceeds from early shares?
I guess I'm a little confused on that. I think that falls under the same category as what we just said. If it's a U.S.-based company and the fund, you can have investors from the U.S. and some investor from overseas, and it's just kind of
maybe he's talking. If you're talking about, Michael, about being able to raise money through other means, it doesn't prohibit you to raise money above the $1 million. You just can't rely on the exemption to raise more than $1 million, but you can rely on other means, a registration statement, a private placement, to raise additional capital. That question had come up in one of my blogs. The manufacturing companies were concerned because $1 million is not enough money to build inventory and do what they have to do to run a successful company, but $1 million certainly is a great jump start, and they can go elsewhere to raise additional capital.
No, this is something that people need to think about as well. Crowdfunding gives them the ability. I mean, this is like before you had to build something and then try it and put it out in the market, and then I was having a conversation a couple of days ago with a friend of mine who's a telemarketer who's got has done a lot of different products and sold on TV. And I laughed and I said to him, how many products do you have in your warehouse that have been sitting there for years that you thought would be a great idea? You put it on TV and all of a sudden you bought 10,000 pieces and you still have 9,990 of them sitting on the shelf. And he's like, a lot. So crowdfunding allows people to actually test their product before they actually, this is a great way to, whether you do crowdfunding for equity or you do crowdfunding donation or product-based, perk-based, it's a great way to vet, to test your product. If you have an invention, what better way to make sure it's viable than pre-selling it through crowdfunding? I mean, if you're going to launch a ketchup that's organic ketchup, then you put it out there and you create the project, you go through this process, and you've got 3,000 people that invest in it. Obviously, there's a market for it because 3,000 people are willing to buy it, right? It's a very different, we talk about focus groups, and it's very easy to ask somebody a question, would you buy this product if it was available? Anybody can check a box that says yes, but it's a very different question is, please give me $25 of your money because of this product, for you to try it. So there's a substantial amount of weight behind hard-earned cash versus a checkbox. So crowdfunding is a great way to make something, whether it's viable or not, besides just the cash.
Thanks, Maurice. I've got another one here which I'll start and then you can finish, Maurice. This comes in from Don. Am I to understand a startup crowdfunder must be a broker-dealer? I kind of touched on this briefly earlier. When it is law, you have to be either a broker-dealer or a registered crowdfund investing portal. And you also have to be a member of FINRA. So as of right now, if there wasn't a mechanism to get the funding portals like Maurice's site registered, the only one you could do it through is a broker-dealer. But there hopefully will be ample time for the portals to be able to get registered and to provide all of the information needed for an issuer to get listed on their site and get funded once it is law. But Maurice, I'm sure you'd like to add to that.
Well, actually, I'd like to say something, because I think this is confusing. He's referring to a crowdfunder, a startup crowdfunder. Is he referring to this, the issuer, or is he referring to the funding portal?
Don, can you just type in if it's the issuer, the company, or the actual intermediary, the portal that will be raising the money?
While he's typing that,
go ahead.
Go ahead, Ruth.
I just wanted to answer Randy's question about the tax returns. The exact language from the bill includes parenthesis, if any. Can you have this clarified? What that means basically is if you got incorporated in January of 2013 and you crowdfunded, say, in October of 2013, you wouldn't have a tax return from 2012. So you wouldn't have a tax return. That's what they mean by if any. So you wouldn't obviously be able to provide a tax return.
Okay.
Okay, just wanted to clarify.
We didn't get. I didn't see an update there for Don, did we?
No, not yet.
No.
We'll
Okay.
get to the next one here. Comes in from Jacques.
Year, as
and
long
an
as
issuer
not exceed 12 months.
And an issuer crowdfund year after year as long as the issuer does not exceed the 12-month maximum. I don't know the answer to that one yet. We have to wait for the SEC to rule on it.
No, it says you can crowdfund. You can only crowdfund the maximum amount in any 12-month period.
So after the 12-month period is up, then you can do another up to $1 million raise.
Yes.
Unless, of course, the SEC rules on that, because I know they have a lot of leeway. For example, on the requirement for audited financials being $500,000 or over, they do have the leeway to either lower or raise that limit. Okay, let's see if okay. Don says he's referring to a company who seeks to raise capital from investors.
So that's called an issuer.
Right.
So he's an issuer, not a funding portal.
So am I to understand a startup crowdfunder, meaning an issuer, must be a broker-dealer? No.
No. That's no. You're just an entrepreneur. You're the same as you are raising capital any other way. You're a small business owner looking to raise capital. It's referred now as an issuer. That's all it is. There's no connection to a broker-dealer.
Correct.
You may be ready to get your Series 7 license after you're done with the process, though.
Yeah, you probably would be able to.
I will.
Is there going to be a limit to the number of companies that'll be profiled on your site?
No, we're scaling that down to about 75 to start with. Only because we've gotten so many companies applying, and we look at all of them. We actually give everybody the same chance. We review them all, and we just want to have the 75 most selected ones. Let's put it that way, without providing any kind of investment advice. I would like to, one thing people should get, there's a lot of great information here today, especially if you're new to this, if you're looking at crowdfunding for the first time. I do want to drive something home to everybody. This is great. This is wonderful. This is game-changing. Just be careful in the next 9 months that you don't alienate yourself from being able to crowdfund. There is going to be repercussion for those companies who are jumping the gun. There are people listing companies on portals right now that even though there's no button there to invest, it's just vote for my company, help me win this competition, et cetera, et cetera, et cetera. But those are not necessarily legal. because the minute you put your company name on a site and it mentions the fact that you're open to equity funding, whether it's directly or indirectly through that website, you, the issuer, or the company is the one who's going to get in trouble. The platform's going to get in trouble too, but it's more on your. It's the same. There's no different than you place an ad in a newspaper tomorrow or a magazine ad saying I need an investor in my company, and you just list the company name and you don't put a phone number on it. Okay, there's very little difference. You know, the SEC is still going to look at it the same way, and you might get an agent show up at your door. So, you know, and what's going to happen is most likely they'll prohibit you from a period of time from doing the crowdfunding, and that'll be their slap on your hand most likely. So, you know, if you're really serious about doing this for your company, don't jump the gun. Either do a non-equity based raise or a true product based, and don't mention don't mention equity in any way, shape, or form, and then validate your product through an actual, you know, product offering. And come January, you actually do a raise on a regular equity-based platform the correct way. But don't jump on ship on these platforms that aren't correctly, you know, legally guided at this point, because a lot of them are out there without the right guidance, and they're just breaking the law, period. And they will get, you know.
And I'd also like to say that we're going to be doing a boot camp for entrepreneurs in Las Vegas in October. So if you really want to get, you know, into all of this and have professional service providers there to help you, this would be a good place for you to get started. And Navocate will be sending out information on this to all of you.
Another question in here from Michael. State law notice registration is still required under the preemption of the National Securities Markets Improvement Act. Why do you believe that notice registration will not be required in each state that a sale is made under the Crowdfunding Act? Maurice, do you know that part of it? I believe that's Section 305 of Title III of the Act.
I don't want to give an expert opinion or say anything like that, but I would say that. You know, the talks we've had with the SEC when that's been brought up as far as state registration, the answer was always, you know, this federal law preempts state registration law. So this is an exemption of the, you know, again, this is new. This is not the way securities are registered today. The way today, you still go through the same process you would go Reg D, and you would have to register it with the state and everything else. Under this exemption, it would be exempt and preempted by the federal law. So my understanding of it from our question, the answer I got was that no, you would not require to register. That might change. You know, they haven't put out the final verdict.
Right, and of course the issuers are never exempt from fraud. The states can still go after them for fraud at any time.
There's nothing in this bill that states that you have any less of responsibility than a CEO of a publicly traded company. If you commit fraud, you're going to have I would say you're going to have more weight on local government, to law enforcement, to go after you, because they're going to want to make an example of this. You know,
and you're
so
coming
it's like
after, you're hurting the average investor.
Right. I mean, you know, it's the grandma on television saying she lost $200. That's going to be, you know, the most decrement. It's not. You know, nobody cries for the guy who lost $12 million to Bernie Madoff. They care about the guy who lost $2,000 of the entire 401k. So, you know, this is going to be an issue of, you know, make sure you do everything right, and make sure. And again, you know, I don't think, you know, what scares me the most about fraud in this particular space is not the fake company. I don't think you're going to have fake companies. I don't think they're going to make it through the crowd, because just like it happened recently on Kickstarter, you know, the guy had a fake game company on there, or a fake game offering, and it was down within 3 days, and the crowd, you know, vetted it out. And, you know, it's easy to convince one person that you're it's easy to con one person or whatever. It's very different to try to convince or con 10,000 or 5,000 or 2,000 people. You know, they're going to, you know, especially when it's all socially based, especially with LinkedIn and Facebook and everything else. You know, within 5 seconds, you can drill down that management team, who they know, where they worked. And if it's sites like Early Shares, and you've used software like, you know, Funding Roadmap, all that information will be available there, and it'll be verified. I know that part of the CrowdCheck program that we've partnered with, checks out not only the company across criminal records and state and federal and securities violations, et cetera, but it also checks their background. I mean, their resume. I mean, if it checks out, where you worked. They verify that you say what you are, it's a very different investment. If you're pitching your company and you're a scientist and you're pitching a new biomedical product, it's important that you are really a scientist. You're not a chef.
Understood.
Well, that's no
we
fair.
got a follow-up from Jacques here, Maurice, for you. Does an issuer have to identify a target amount? Can they lower the target amount in a 12-month period? And what happens if the issuer doesn't raise the target amount?
Okay. There is something in the bill that talks about a minimum max kind of setup. There's nothing. You do have to have an all or nothing funding. So in other words, you have to say, I need $100,000. This is what I would use it for. This is my use of proceeds. This is what I'm offering, etc. But there is some vague language in there, and again, it will be up for the final ruling that will say, I'm looking for $100,000, but I would take $150,000. And then obviously the more you would give up slightly more equity. If you're giving up 10% for 100 and then 15% for 150, that would be, under $1 million valuation. But there is an all or nothing. So whatever that minimum is that you set on your funding, it has to be met in order for it to be released. And among other things, on our particular platform, just the fact that you met the number doesn't mean it's released. You have to pass the secondary due diligence process.
Thanks, Maurice. Another one from George. Are portals interested or allowed to host both perk and equity startups so that they can grow up on the same platform and the same crowd can come to a single location to find viable, vetted, growing deals? So I think they're probably allowed, but... No.
That's the problem. No, they're not. That's the problem. That's why the SEC is upset right now. This is why we're having so many problems with these. That's why I was telling people, don't put your company out there yet. The SEC is very concerned with, they've shown to be very concerned with the miscommunication or the confusion factor from people. These are, they're so concerned these are unsophisticated investors that they don't want people, if it says equity crowdfunding on the website, they don't want to see non-equity offerings on there because it's going to confuse people, and then they don't understand that right now they can't do equity, and then later they can, and right now you're violating solicitation rights by saying that this company would take money. I mean, there's a website out there now that says, we're trying out this, here's 6 projects, here's a product, here's a bicycle, here's this, here's that, and you can go and contribute to that product, and you'll get a sample product, and then there's a little button on the right that says for equity, click here. You click there, it says it's not available yet, come back in January, but it already told you the name of the company, it already told you that they're looking for money, so basically you're already violating the law. So that's where the confusion part is now. So I think that if you have a product and you want to test it, and I think pre-sale is a great way to test it. Go to Kickstarter and list your product there and get traction of it, get proof of concept, and make some money on it. Great. But if your interest is equity and a larger stake that's going to fund your company, wait till January. Do not put your hand out there to be slapped, because it will be slapped.
Right. However, Maurice, if I have a company and I'm Nuco.com, and in January I do my first raise, and 2 years from that time I'm now making money, I can come back to you, correct? And do a second
you can
raise.
Come back you can do it. You can do it in the same year. You don't have to wait as long as you didn't go over the $1 million mark. You can have 4 raises in 1 year if you wanted to.
That was just my example. So George, if you find a company on a platform site that you like, you can track that company over time for subsequent offerings.
I think George was asking if these sites, these portals, are going to offer both perked and equity at the same time.
Right. The answer to that is yes, and there's no problem with it after January. The problem is that companies are trying to use the non-equity as a carrot, per se, to create momentum and bring people to the site right now by confusing the end user with equity versus non-equity all on the same platform. And even though right now equity is not available right now, but here's a company looking for equity later, and they're listing the companies, and that's what's creating confusion and getting everybody upset because just obviously it's just not plain black and white. Either you're equity or you're not equity. But eventually, once it's all legal, once the rules have been set and everybody can play by the same rules, then there's nothing that says that if you have an equity website, you can't offer non-equity offerings, and there's nothing that says you can't offer perks with it. So you can have a donation, you can have an equity, and you can have a perks based all in one platform come January. Right now, you cannot have a crowdfunding equity-based platform that is advertising non-equity offerings on there right now. I cannot launch early shares right now and put crazy ketchup on there for donate $25 and get a box of ketchup. That wouldn't fly.
Understood. It sounds like the name of the game is education and preparation to get ready for next year.
Right. I mean, if I'm an issuer, I'm a small company and I got a product, I would, and I really want to get traction, I want to test that product right now, I would do a donation-based campaign. I wouldn't even touch anything to do with equity. I wouldn't go to an equity site. I would go to a donation site that's successfully run, like Kickstarter or similar, and I would launch it and test my product there. And then get the traction. So when you come back to an equity site like Early Shares in January, you can say, look, I had a campaign. Part of your pitch can be I had a campaign in August and I sold 50,000 cases of this, and I'm in 20-some stores, and I'm doing this, and this, and now I need $250,000 to set up my factory, and this is why. I've proven my success. I've got my track record here. You can use that as your validation. That's what I would do.
Thank you. Mickey asks, for an individual investor who invested through crowdfunding, non-accredited, is there any way to get out other than the liquidity event or IPO? Can you de-invest or sell it? Went over this a little bit earlier. You can sell it back to the issuer. You can sell it to an accredited investor during this one-year period of time, and you can sell it under certain circumstances to family members, and examples of that are through an estate, through death, or divorce.
There's actually one more
there.
That,
that's one of the reasons that we partnered, Navocate has partnered with Early Shares, is when the company does get to the point where they have revenues typically between $3 and $30 million, we can help with the merger and acquisition portion of that and perhaps create a liquidity event for the investor then.
Correct.
Maurice, you had another comment?
Yeah, well, depending on how the deal is structured as well, in our particular, again, SC doesn't change the way this structure, has to be done. We're incorporating all the shareholders into a separate entity, and that entity is the shareholder of the main company. So therefore, first right of refusal plays in. So if somebody wants to get out, they can offer to an accredited investor, or they can offer to any of the existing shareholders. So if you have one share of $200 and you have to sell it, then you can offer to the other shareholders of the company, as well as the issuer. So there is, while there's no, it still applies to the 1-year limit, though.
Well, Carl, I don't see any other questions coming in at this point.
Right. Okay. Thank you all who participated as panelists. Thank you all who hung in here for almost, 2 hours. We really appreciate your attendance. We will be contacting you to let you know how you can access the recording, how you can access the PowerPoint. Panelists, I'm thinking that it might be very interesting to transcribe some of this Q&A and make that available, so that's something we can think about and do. I think that the group that you have listened to today is a group that will be interested in continuing to provide ongoing updates as we run the race to January 1st, because obviously there are going to be a lot of changes in regulations, in interpretation. As Maurice pointed out, we're going to see some companies that may try to be cheating and get out in advance of the gun. What happens to them? What makes this exciting is that this is all a brave new world for all of us. So we'll be here to help you through it. Thank you very much again, and have a great day.
Thank you, guys.
Thank
Bye
you,
now.
Gabby.